Ladies and gentlemen, Asian guy here, and if you're watching this thinking your family is safe, thinking your job is secure, thinking your mortgage is manageable, I need you to understand something right now. What I'm about to share with you, what I discovered buried in publicly available pension fund filings and actuarial reports, is not another economic analysis. This is a mathematical death sentence. For 78% of you watching this right now, 78%, and it's calculated, documented, and projected down to the exact month when your life as you know it ends. The analysis comes from examining strategic portfolio rebalancing assessments from pension funds managing over $47 billion in assets for 2.3 million American workers. And buried in these filings, hidden in actuarial language that most people would never understand, is a single projection that should make every middle-class family in America stop what they're doing and pay attention. The actuaries, the mathematicians whose entire career depends on being right about the future, have calculated that 78% of current middle-income households will experience what they call catastrophic wealth destruction within the next 24 to 36 months. Not might experience, will experience. Mathematical certainty. And catastrophic wealth destruction is defined very specifically. Loss of home ownership through foreclosure, depletion of all emergency savings to zero, inability to service debt obligations without liquidating retirement accounts, or bankruptcy filing. One or more of those outcomes will hit 78% of middle-class America before this decade is halfway finished. The median American household earns approximately $84,000 per year, according to current Census Bureau data. That's you. That's the family next door. That's your coworker. That's 78% of everyone you know. They own a home with a mortgage payment that's eating them alive. They're carrying their share of the $1.2 trillion in credit card debt across America that just hit an all-time record high. They have 2 cars with payments. They think they have some savings, maybe $12,000 and perhaps $60,000 in a 401k. They believe they're building wealth. They believe they're doing everything right. And according to these actuarial assessments prepared by people who calculate risk for a living, they're wrong. They're not building wealth. They're running on a timer. And that timer is counting down to zero faster than they realize. The moment total household debt in America crossed $18.6 trillion, the trap closed. Most people just haven't felt the teeth yet. Now, before I show you the exact mathematical breakdown of how this unfolds, before I prove to you why 78% is not alarmist, but actually conservative, you need to understand something the mainstream financial media will never tell you. The middle class isn't shrinking because people are moving up into prosperity. The middle class is being systematically destroyed by a debt trap that was engineered over 2 decades and has now reached the terminal phase. And these pension fund filings prove that the people managing trillions of dollars, the people who are supposed to protect retirement savings for American workers, they know exactly what's coming. They're not advertising it. They're not broadcasting it on CNBC. But they're preparing their portfolios. They're moving money out of retail stocks, out of restaurants, out of consumer discretionary sectors. They're rotating into distressed asset managers, into companies that buy foreclosed homes at auction and rent them back to the same people who used to own them. They're positioning for a world where the middle class doesn't exist anymore, where there are only 2 categories of Americans, the owners who buy the assets and the indebted who lose them. And they're doing it right now while you're still trying to figure out whether you should pay down your credit card or contribute to your 401k. Let me show you the mathematics. Let me show you why this isn't a prediction, but a timeline already in motion. The median middle-class household earning $83,730 per year, they pay approximately $29,000 in federal, state, and payroll taxes. Social Security, Medicare, income tax, state tax, if they're in a state that has it. That leaves them with $54,730 in actual take-home income. That's $4,561 per month hitting their checking account. Now watch what happens to that money. The median home price in America as of January 2026 is $417,000 according to the latest real estate data. If this family bought in the past 3 years and millions did, they have a mortgage at somewhere between 6.2% and 7.1% interest because that's where rates have been. On a $350,000 loan, which would be typical after a down payment at 6.8% interest, their monthly principal and interest payment is $2,293. Add property taxes, which average $320 per month nationally. Add homeowners insurance, which just hit an all-time high, averaging $185 per month and climbing 11.3% year over year. Add HOA fees or basic maintenance averaging $150 per month minimum. Their total housing cost is $2,948 per month. That's 64.6% of their take-home income of $4,561. 64.6%. The rule? The standard that every financial advisor tells you is that housing should consume no more than 30% of income. They're at 64.6. They're already drowning, and most of them don't even realize it yet because the water hasn't reached their nose. But it's coming. And here's where it gets worse, where the mathematics become unavoidable. They have 2 car payments. The average new car payment in America is $550. 2 cars, that's $1,100 per month. Car insurance, which has also exploded higher, averaging $245 monthly. Gas and maintenance, conservatively, $280 per month. Total transportation costs $1,625 per month. Add housing at $2,948. They're now at $4,573 in obligations. But remember, their take-home pay is only $4,561. They're already $365 per month in the hole before they've bought a single gallon of milk, before they've paid a single utility bill, before they've charged a single purchase to a credit card. So where does that shortfall come from? It comes from credit cards. They charge groceries. They charge utilities. They charge phone bills, internet, streaming services. They charge kids' activities and school supplies. They charge the occasional dinner out because they're stressed and exhausted. They charge medical copays and prescriptions. The average American household is charging $1,260 per month in basic living expenses, according to recent consumer spending data. And they cannot pay it off. They can only make the minimum payment. The average credit card debt per household in America is $10,668. At an average APR of 25.3%, which is where rates are sitting right now, the minimum payment on that balance is approximately $237 per month. But here's the trap. When you only make minimum payments at 25.3% interest, you're not paying down the principal. You're feeding the beast. The balance grows. Every month you charge $1,260 for basic living and pay $237. The difference, $1,023, gets added to your debt. Your balance next month is $11,691. Your minimum payment rises to $246. The spiral accelerates. Let me show you the timeline. The actuaries in the leaked document calculated this down to the month for the median household. They start January 2026 with $12,000 in their checking account. This is their cushion, their emergency fund, the money that's supposed to protect them, at a burn rate of $1,862 per month, which is the gap between their income and their obligations when you factor in all the housing, transportation, minimum payments, and basic living expenses they're putting on credit. That $12,000 cushion lasts 6.4 months, 6 months. By July 2026, the checking account hits zero. And now they face a choice that 66 million American families are going to face in the next 24 months. Option 1, stop paying the mortgage and face foreclosure proceedings within 90 days. Option 2, stop paying the car loans and watch both vehicles get repossessed within 60 days. Option 3, stop buying groceries, which isn't an option when you have children. Or Option 4, drain the 401k. Most families choose Option 4. They convince themselves it's temporary. They tell themselves they'll pay it back. They take a hardship withdrawal of $20,000 from their retirement account. But here's the penalty. When you withdraw money from a 401k before age 59 and a half, you pay ordinary income tax plus a 10% early withdrawal penalty. On a $20,000 withdrawal for a family in the 22% tax bracket, that's $4,400 in federal tax, plus maybe $1,000 in state tax depending where they live, plus $2,000 in penalty. $7,400 vanishes to taxes and penalties. They net $12,600. At their burn rate of $1,862 per month, that $12,600 lasts 6.7 months. By February 2027, 14 months after this nightmare began, the 401k money is gone. The checking account is still at zero. And now the credit card balance, which was $10,668 when this started, has grown to $22,400 because they've been charging $1,260 every month while only making minimum payments. The minimum payment on $22,400 at 25.3% APR is now $592 per month. Their monthly shortfall has grown from $1,862 to $2,217. And they have no more cushions, no more savings, no more retirement, no more options. Now they stop paying. They stop paying the credit cards first because those are unsecured debt. Within 90 days, the accounts go to collections. Within 180 days, they're charged off, and their credit score, which was maybe 680 or 700 at the start of this, drops to 450. They stop paying the car loans because they need the mortgage more than they need the cars. Within 60 days, both vehicles are repossessed. Their credit score drops to 370. They try to keep paying the mortgage, but they can't. The payment is $2,948, and their entire take-home income after taxes is $4,561. Without cars, one spouse can't get to work. Income drops. They fall behind on the mortgage. 30 days late, 60 days, 90 days. The foreclosure notice arrives. By mid-2027, 18 months into this spiral, they've lost the house, lost the cars, destroyed their credit, depleted their retirement, and they're living in a rental apartment or with family or in a motel, starting over from absolute zero. That is catastrophic wealth destruction. And the leaked actuarial document, prepared by people whose job is to model the future with mathematical precision so they can manage $47 billion in pension assets, projects this exact sequence will affect 78% of middle-class households by the end of 2028. Not because these families are irresponsible, not because they made obviously bad choices, but because the mathematics of their situation make any other outcome impossible. The debt is too high, the income is too low, the expenses are too rigid, the trap has already closed, they just don't know it yet. But the actuaries know, the pension fund managers know, and now you know. Let me show you why this is already happening, and why the numbers are accelerating faster than anyone predicted. According to data from Bankrate released January 12, 2026, 61% of Americans with credit card debt have been carrying that debt for at least 1 year. That's up from 53% just 14 months ago, an 8 percentage point increase in barely over a year. 22% of credit card debtors, more than 1 in 5, say they don't believe they will ever pay off their debt, ever. They have accepted permanent indebtedness as their reality. They've given up. And total credit card debt in America hit $1.233 trillion in Q3 2025, according to the Federal Reserve Bank of New York. That's an all-time record, $1.233 trillion. But credit cards are just the visible part of the iceberg. Total household debt, every form of consumer debt combined, mortgages, auto loans, student loans, credit cards, personal loans, HELOCs, reached $18.59 trillion in Q3 2025. $18.59 trillion. The average American household now owes $105,056 in total debt. That includes $268,060 average in mortgage debt for those who have mortgages, about $16,600 in auto loans, the student loans, the credit cards, everything. And here's where this becomes a crisis instead of just a statistic. Delinquency rates are rising. The percentage of credit card debt that is at least 90 days delinquent, which is the threshold where the banks consider it seriously delinquent and start writing it off, hit 3.03% in Q3 2025. That sounds small until you realize that represents $37 billion in credit card debt that borrowers cannot pay. $37 billion. And the trend is accelerating. Delinquencies have been rising for 11 consecutive quarters. This is happening while unemployment is still at 4.2%, historically low. This is happening while the economy is technically still growing at about 2.6% annually. This is happening before the recession that many economists are giving a 35 to 40% probability of hitting in 2026. What happens when unemployment rises from 4.2% to 5.5 or 6%? What happens when millions of households that are already burning through savings at $1,862 per month suddenly lose their income entirely? The 78% becomes 90%. The catastrophic wealth destruction accelerates from a 24-month timeline to a 12-month timeline. And the pension funds know this. That's why the document exists. They're modeling the collapse. They're calculating how many of their beneficiaries, the middle-class workers whose retirement they're supposed to protect, won't be able to retire at all because they'll have lost everything by 2028. Let me show you the housing trap, because this is the accelerant that turns a difficult situation into a catastrophic one. The median home price, $417,000. But the income required to afford that home at today's interest rates has more than doubled since 2019. In 2019, you needed household income of approximately $59,000 to afford the median home. You put down 10 or 20%, you got a mortgage at 3.5 or 4%, and your payment was manageable. Today, to afford that same median home, you need household income of $118,000. The median household income is $83,730. The gap is $34,270. 73% of American households cannot afford to buy the median priced home today, even if they wanted to. And here's the trap for people who already bought. If you bought in 2022 or 2023 when prices were peaking and rates were starting to rise, you have a mortgage rate between 6 and 7.5%. Your monthly payment consumes 50 to 70% of your take-home income. You're trapped. You cannot refinance because rates are still above 6%. You cannot sell without taking a loss because in many markets, prices have actually declined from peak. Florida is down 3.4% from peak. Texas down 2.1%. Arizona down 3.8%. Phoenix, Las Vegas, Austin, Tampa, these markets that exploded during the pandemic are now contracting. Homeowners who bought at the peak now owe more than their home is worth after you factor in the 6% realtor commission and the closing costs. They're underwater. They can't sell without bringing cash to closing. They're trapped in a home they can't afford with a mortgage. They can't refinance at a payment they can't sustain. And the expenses keep rising. Property taxes up an average of 6.2% nationally in the past 12 months. Homeowners insurance, and this is critical, up an average of 11.3%, with some states seeing increases of 30 to 40%. In Florida, the average homeowner's insurance premium has risen from $1,988 per year in 2020 to $4,231 per year in 2026. That's an increase of $2,243 annually, or $187 per month. For a household already running a deficit of $1,862 per month, that additional $187 is catastrophic. It's the difference between making it 6 months and making it 4 months. It's the straw that breaks the camel's back. And it's happening to millions of families simultaneously across Florida, Louisiana, California, Texas, every state where insurance costs are exploding due to climate risk, hurricane risk, wildfire risk, and insurers pulling out of markets entirely. The leaked document specifically identifies rising housing-related costs as one of the 3 primary mathematical drivers of the projected wealth destruction: property taxes, insurance, HOA fees, maintenance, utilities. The second driver is debt service costs at elevated interest rates. When your credit card charges 25.3% and you're only making minimum payments, the math is brutal. The third driver is real wage stagnation. Nominal wages, the number on your paycheck, have risen about 4% per year since 2021, but inflation has averaged 4.8%. Real wages, purchasing power adjusted for inflation, have declined. The average worker can buy less today than they could in 2019 despite earning more dollars. You're making more money and getting poorer simultaneously. When you combine those 3 forces, elevated housing costs, high interest debt, and declining real wages, you get mathematical inevitability. The middle class cannot service their obligations. They will default. They will lose their assets, and it will happen fast. The document projects 3 waves. Wave 1, Q2 2026 through Q4 2026, affects approximately 22% of middle-class households 9 months from now. These are the most vulnerable families, the ones who entered 2026 with less than $5,000 in savings, credit card debt above $15,000, housing costs above 65% of income. They're the first to run out of money, first to default, first to lose everything. By December 2026, the actuaries project 18.7 million households will have experienced catastrophic wealth loss, 18.7 million families. Wave 2, Q12027 through Q32027 affects approximately 31%. These are households that had more cushion, maybe $15,000 in savings. Maybe they'd paid down some debt, but the cushion runs out. The HVAC system fails and costs $4,200 to replace. Somebody needs emergency dental work, $3,800. The transmission goes out on one car, $2,900. Any single unexpected expense tips them from struggling into insolvency. By September 2027, cumulative total reaches 44.3 million households destroyed. Wave 3, Q4 2027 through Q4 2028, affects the final 25%. These are families who thought they were safe. They had $30,000 in savings. They had manageable debt. But then the recession hits. One spouse loses their job. Unemployment benefits replace maybe half their income. At 50% income, there is no mathematical way to service the debt. They have to choose between the mortgage and food. They choose food. Foreclosure proceedings begin. By December 2028, cumulative total is 66.2 million households. 66.2 million. That's 78% of the 85 million households that the Census Bureau classifies as middle income earning between $50,000 and $150,000 annually. 78%. The number in the leaked document, the number that pension fund actuaries calculated with the same mathematical precision they use to ensure they can pay retirement benefits decades into the future. And this projection is not based on sentiment or politics or fear. It's based on cash flow analysis. The actuaries took the median household balance sheet, plugged in actual debt levels from the Federal Reserve, actual interest rates from the banking system, actual housing costs from real estate data, actual wage growth from the Bureau of Labor Statistics, and they ran the simulation. How long can this household mathematically sustain current consumption before they hit zero? And the answer, for 78% is somewhere between 6 months and 30 months. From January 2026, the median timeline is April 2028, 27 months from today. That's why the document says by 2028, because by April 2028, the mathematical median household reaches catastrophic wealth destruction. The money runs out, the defaults begin, the foreclosures cascade, and the greatest wealth transfer in American history accelerates into overdrive as the owners buy the assets of the destroyed at 10 cents on the dollar. Now let me connect this to forces in the broader economy that make the situation worse, not better. Force 1, the end of pandemic-era excess savings. In 2021 and 2022, American households collectively had about $2.1 trillion in excess savings. Stimulus checks, enhanced unemployment, student loan payment pauses, reduced spending during lockdowns. That cushion is gone. According to the Federal Reserve analysis, excess savings were fully depleted by Q2 2025. 7 months ago, the buffer that helped millions of families survive. The inflation of 2022 and 2023 no longer exists. They're running on fumes. Force 2, real wage decline despite nominal increases. Your paycheck number went up, but your purchasing power went down. This is the invisible tax of inflation. Force 3, the mortgage rate lock in effect. Millions of homeowners have mortgages at 3 to 4% from 2020 and 2021. They want to move. They need to downsize or relocate or upgrade. But if they sell their current home, they have to buy a new one at 6.5 or 7%. Their payment would double. So they stay trapped in homes that don't fit their needs anymore, which reduces housing inventory, which keeps prices elevated, which traps first-time buyers out of the market entirely. It's a doom loop with no exit. And Force 4, the insurance availability crisis. In California, State Farm, Allstate, and Farmers have stopped writing new homeowners policies in high wildfire risk areas. In Florida, 6 major insurance companies have declared bankruptcy since 2022 due to hurricane claims. In Louisiana, premiums have doubled or tripled. Homeowners in coastal areas are discovering they cannot get insurance at any price. And without insurance, you cannot have a mortgage. Without a mortgage, you cannot sell your home because no buyer can get financing. The house becomes functionally worthless. This is happening right now in parts of California, Florida, and Louisiana. The leaked document specifically mentions insurance availability as a systemic risk that could accelerate the wealth destruction timeline because if millions of homeowners cannot insure their properties, the entire housing market in those regions collapses instantly. Banks foreclose, values crater. Families lose everything overnight, not because they stopped paying, but because the insurance market failed. So what does this mean for you if you're watching this and you're in the middle class earning between $50,000 and $150,000? You need to understand with absolute clarity that you are statistically in the 78%. Your household is one of the 66.2 million that actuaries with $47 billion under management have calculated will experience catastrophic wealth destruction by the end of 2028. And you have exactly 2 choices. Accept that projection as your destiny and do nothing, which guarantees you lose everything right on schedule, or fight like hell starting today to become part of the 22% that survives. Here's what survival requires, and I'm not going to sugarcoat this. These are not comfortable actions. These are not easy steps. These are extreme survival measures for an extreme crisis. First, eliminate all consumer debt immediately, not eventually, not when you feel like it. Immediately. If you have $10,668 in credit card debt at 25.3% APR, that debt is costing you $2,700 per year in interest alone. That's $225 every single month that could be going to savings, could be building a buffer, but instead is being incinerated to pay interest to banks. Stop contributing to your 401k if necessary. Stop everything except minimum required expenses. Attack the debt with every available dollar until the balance is 0. Yes, this violates conventional wisdom that says always get the employer match on your 401k. But conventional wisdom assumes a stable environment. We are not in a stable environment. We are 24 months from 78% wealth destruction. Survival requires abandoning conventional strategies. Second, reduce your housing cost below 40% of take-home income. If your mortgage is consuming 64.6% of your paycheck, you will not survive. You have to move. Sell the house if you can, even if you take a loss. Rent something cheaper if you have to. Move to a lower-cost city. Move to a smaller place. Downsize aggressively. Yes, you will lose money on the sale after realtor fees and closing costs. Yes, moving is expensive and disruptive and emotionally painful. But losing money on a controlled sale today is infinitely better than foreclosure 18 months from now. Taking a $10,000 loss on a sale is better than catastrophic wealth destruction. Third, build a 12-month emergency fund. Not 6 months, 12 months minimum. 12 months of essential expenses in cash in a high-yield savings account earning 4 to 5%. Not invested in stocks, not in crypto, not in anything volatile, and cash. Because when Wave 1 hits in Q2 2026, when Wave 2 accelerates in Q1 2027, when companies start laying people off and unemployment rises, you need liquidity immediately. You cannot wait for the stock market to recover or for your home equity line to be approved. You need cash that you can access today. 12 months is your buffer. That's what keeps you out of the 78% when everyone around you is defaulting. And fourth, diversify your income sources. If your family relies on a single job, a single employer, a single source of income, you are vulnerable. When that job disappears, your income drops to zero plus unemployment benefits, which typically replace only about 40 to 50% of your previous income. And at 50% income, you cannot service your current debt obligations. The math breaks immediately. You need side income, freelance work, consulting, a small business, rental income if you can manage it, multiple streams, so that if one disappears, you don't immediately fall into the catastrophic destruction category. These actions are not comfortable. They require sacrifice. They require admitting that the life you're living right now is mathematically unsustainable. But the alternative is losing everything. The alternative is being part of the 66.2 million households that the actuaries have already written off. Today is January 24th, 2026. You have 27 months until the median timeline for catastrophic wealth destruction in April 2028. That's 810 days. Every day that passes without action is one day closer to the edge. The middle class, as we have known it for 80 years, the middle class that defined the American dream, home ownership, secure retirement, upward mobility for your children, that middle class is ending. Not because of globalization, not because of automation, not because of any abstract economic theory. It's ending because 78% of middle-class households are mathematically trapped in a debt spiral that they cannot escape without losing everything they own. The leaked actuarial document proves it. The pension fund managers have calculated it, and now you know. The question is what you do with that knowledge. You can dismiss this as fear-mongering. You can tell yourself it won't happen to you. You can hope the government does something, or the Federal Reserve steps in, or some miracle occurs. Or you can look at the mathematics. $18.59 trillion in household debt, $83,730 median income, $1,862 monthly deficit for the median household, 6 months until the savings run out, 18 months until the foreclosure, 24 months until catastrophic wealth destruction. The numbers don't lie, the actuaries don't guess, and 78% is not a prediction, it's a timeline. The end of the middle class isn't coming, it's here. Wave 1 begins in 90 days, 18.7 million households by December 2026, 44.3 million by September 2027, 66.2 million by December 2028. The leaked assessment has been exposed. The mathematical certainty has been documented. And the countdown is running. Hold less debt. Build more savings. Cut your costs. Diversify your income. Fight to be in the 22% that survives. Because 27 months from now, the America you grew up in, the middle-class prosperity that seemed like a birthright, will be gone. And all that remains is a choice you make today. Owner or indebted, survivor or casualty, 22% or 78%. The actuaries have done the math. The clock is ticking, and catastrophic wealth destruction waits for no one.